Brian, we are back, episode 2 of this live show. It's great to have you back.
Good to be back.
Awesome. Well, maybe we could start off before we hop into all the good stuff with, Bitcoin. There's a lot going on with MSTR right now and mainstream media trying to fund that. But before we hop in there, maybe we could just start off with a quick update on your end. Anything you'd like to share, then we'd hop in.
Yeah, so just a quick update from me. I have parted ways with H100 Group. I am no longer the head of Bitcoin strategy there. And I think there's not really a big story to tell there. H100 Group, they decided to concentrate their operations in Lugano, Switzerland, which is where Sander is based. Also, the CEO, Johannes, moved there, and the new head of marketing is there. And so the arrangement just didn't really make a lot of sense. So we decided to part ways. We did so on friendly terms. And, I'm a free agent again. Happy to be back here with you talking Bitcoin treasuries.
All right, Mr. Free Agent, let's go. Well, thanks for the quick update there, Brian. But yeah, let's get into it. I mean, Bitcoin, I think, went from like 90K to 94.5, 95 yesterday within just like a matter of minutes. What was your read on that? It's like market opened, and I think even just taking a little step back, a lot of people have been following Jordy Visser. He's put out a lot of great pieces. We talked about his article he wrote about Bitcoin's IPO moment a couple of weeks ago. He made this post on X yesterday, maybe 30, 40 minutes before market open, basically saying that he was seeing a good setup with BTC because of how risk assets were sort of leading more quality stocks over the past 10 to 11 days, I think was his analysis. So he saw a good setup. He posted about it. Market opens and Bitcoin literally goes vertical. So curious to hear your read on that. It's obviously pulled back since, but it was a little crazy considering the muted sort of price action we've seen over the past couple of weeks here.
Yeah, I think for any one particular day, I think it's difficult to pin down price action. But there's been some interesting things happening recently. I forget what day exactly went live, but the Vanguard is opening up their platform to Bitcoin ETFs. So that it's been another tailwind for volume. And we've got the FOMC happening. So there's always lots of volatility around that. So yeah, it was good to see Bitcoin price back a little bit. There's if you track, depending what measures of global volatility or not volatility, liquidity you track, liquidity is up a little bit last week as well. So there are some tailwinds right now, but it's stop start choppy. I think we don't have like a clear QE situation, a clear secular rate cut trend happening. So I think the market is in kind of this jittery shoot up, shoot down, chop around place. Probably will continue to be, but for now, let's enjoy a little Bitcoin upside.
Absolutely, absolutely. Do you think it had anything though to do with 21 Capital, Jack Mahler's new firm? They went public yesterday. And as I was thinking about this, I was like, okay, like it almost seemed like, that move up could not have been driven by retail. So like some institutional buyer must have been in there. And I was like, okay, maybe it's 21 Capital, or, maybe it was, another play similar to the, Jim Channels, short MSTR, buy Bitcoin. So 21 Capital was also like down 20% yesterday. Meanwhile, Bitcoin made this move. So or maybe you just think that's all speculation and not even worthy of discussion. But I'm curious to hear your take on that, if you think there's any connection there.
For the 21 for their merger closing, I kind of don't think so. Just typically what happens when these mergers close is that the price goes down, and it's just because you've got probably shares didn't unlock yesterday, but anytime you've got one of these big pipe deals, these big SPAC deals, whenever it closes, it's just kind of like the natural thing to happen is that there's, to sell the news event, and price comes down closer to whatever the initial price was. And so that's probably what I would attribute most of a move down in 21 to. But it's very good to see that they are finally public. I think a lot of people kind of forgot about them, but they are currently the third largest holder of Bitcoin, the third largest corporate holder of Bitcoin. And yeah, they're only just now getting started. So I kind of doubt they did a big smash buy on day one, but they're definitely a company to watch. In my book, they are probably, a shoe in for soon to be number two. Deep, deep pools of capital behind them. Both Tether and Cantor behind them.
Mhm.
Some of the deepest pockets around you'll find. So I'm very optimistic about what the company will do, but it's very early stages. They're just finished their merger. They're just trading live now. So we'll see what the coming months bring.
For sure, yeah, it'll be interesting to watch, and maybe we can move on to MSTR a bit here. So I think about a week ago, week and a half ago, they raised close to $1.5 billion for a new cash reserve. A lot of folks in traditional media were, writing articles about, is MicroStrategy going to have to sell their Bitcoin to, pay off their dividends, to, service their debt, things like that. And the company's response, it seems, was to create this new cash reserve. Basically, gives them 18 months to 2 years, roughly, of runway to be able to service their liabilities there on those payments. Um, you know, there was a lot of there was a big reaction around this. I think the stock may have even dropped that day, and that might have been the local bottom. Maybe it hit 150 or so. And so it seems like the market's initial reaction to them raising money was, a bit of caution or concern. MicroStrategy turned around, I believe, in their most recent announcement, where they've actually used some of the money they raised to purchase Bitcoin, and I'm pretty sure the ATM that they used was on the common, right? On MSTR, they raised about $1 billion. So, what's your read on how the market sort of interprets these big raises and what they might be using the capital for? They raised $1 billion using the common ATM to purchase Bitcoin. Market doesn't seem to, turn on CNBC and hear about that. They raised this 1.5 billion. Everyone's talking for the cash reserve. Everyone's talking about it. So yeah, curious what your read on that was.
Yeah, I think the cash reserve was a very positive move. I think the reactions it drew were very mixed. But if we rewind the cycle a little bit, I think part of the impetus for doing that is that when Strive launched their preferred stock, SETA, they said, we're going to hold back. I think it was 10%. But basically, to have a year's worth of dividends covered, right from the get go. And a lot of people, really like that move because it gives war certainty to whether or not the dividends are going to be paid. Especially if 2026 is an end of cycle down year, which it might not be. I personally don't think it will be, but if it is, it's much better to have that cash on hand now than be trying to ATM strategy shares at $100 6 months from
Mhm.
now to pay the dividends. So I think some of the negative reactions that it drew really hadn't thought through what some of the alternatives might be for paying the dividends. I don't think that strategy is going to struggle to pay them by any means. They have lots of options at their fingertips, but I think that building a cash reserve now is a wise move, given what some of the other alternatives could be. And I think that something else that people said, well, why is the common supporting the preferred shares? Well, that was always the plan. If you didn't realize that,
Mhm.
you haven't been paying attention. Um, but I think the reason that people are unhappy is just because the share price is down. That if Bitcoin were at 150K right now, and more of the benefit of these preferred shares was being realized to the common shareholders, I don't think anyone would be complaining that much. Um, and I think that's where you have to keep in mind that these preferred shares, they are more of a longer term play. The promise is, we're going to finance a Bitcoin purchase at 10% interest, and then anything above that is gravy to the common. Of course, that only works when Bitcoin is going up. and that could take time. Right now, this year Bitcoin has been flat to down, but unless you think that is how Bitcoin price action is going to be forever, then I wouldn't be too concerned about that. Um, the market just has to give this time to play out. And then I think what people responded to positively was that they came back the next week. People, I think, misread this as a sign of weakness on Strategy's part. So they raised another $1 billion, bought another 10,000 Bitcoin, and MNAB wasn't that high. Wasn't that massively accretive, but I think it was kind of a shot across the bow to say, hey, you know what, we're fine. We can still go out and buy 10,000 Bitcoin in the market whenever we want to. So that's kind of how I interpret the second move. And the market seemed to like it. Prices rebounding pretty significantly, and we'll see where we go from here.
To your point about them raising that capital now while the stock is, trading around 200 versus, waiting until, if, we enter a bear market, waiting until, that point to raise that capital. Why do you think they didn't do something like this earlier, right? The stock, traded in the $300, $400 range most of the year. We peaked last year. Maybe that's just not something that was on their radar, but yeah, why do you think this is, something that they're just doing now?
I think the answer probably is as simple as that they just didn't think of it. It wasn't really even in the public consciousness at all that it was something that might be a good idea to do. And also, I think nobody, if you asked literally no one, if you asked them earlier in the year, would have thought that Bitcoin would be under 100K right now. They would have had
Except Peter Schiff,
predictions,
but
yeah, except Peter Schiff. Everyone else on the planet thought we'd probably be substantially higher right now. And so, it's an evolving playbook. Um, and you don't necessarily think of every possible angle up front. And so, and then something else that happened, between then and now is that they got their credit ratings, and some of the feedback on the credit ratings is we're concerned about potential dollar liquidity,
Mhm.
and having a cash reserve to pay the dividends that should be a positive thing for credit ratings because that improves that dollar liquidity situation. And so I think just for a number of reasons it made sense to do. Even if people weren't happy about common being sold in the short term, I think that for long-term plans it makes a lot of sense, and it was a good thing to do. And I think more broadly, something I'm thinking about in the space is that the plans these companies are doing. If you issue a 5-year convertible bond, I think it's even though Strategy doesn't do that anymore,
Mhm.
it's helpful to think about that time frame as kind of being the benchmark for a plan to pay off. And the benchmark for a preferred to pay off is potentially being even longer than that. And these are plans that take more than a single quarter to pay off, and certainly more than a single week. And so I think that the market is kind of in this habit of just seeing what was the what how much was bought on this Monday's 8K, and where's Bitcoin at today. And you just have to have a much longer time frame you're looking at when you're thinking about how these preferred strategies are going to play out, and the benefit that could potentially bring to the common shareholders.
Yeah, that's great. And I think the beauty of this too is that like, if you again, turn on CNBC and you listen to what they're saying about it, it's like, okay, well, strategy, they're now good for the next 18, 20 months to pay this off, but they can just run it back. And once that period's over and raise the capital again, they've proven over and over again they're able, like the 1.4 billion for them isn't that crazy to go out and raise. They did that last week, like we were talking about, to buy more Bitcoin. Um, but do you think there'd be any benefit to, is it like, do you think it'd be better to just like they did to just do this in one full swoop, or could there be an advantage to, doing this more, building the cash reserve more incrementally over time, as opposed to just, okay, selling shares, raising this cash, holding it there, right? Sailor's whole thing is fiat, it's a melting ice cube, and now you're holding this, for you're holding cash for an indefinite period. Obviously, you'll be using some of it to service preferreds over time, but some of that could be far out, right? So you got the time value of money to think of there.
Well, I think they probably will continue adding to it just because their the liabilities are going to keep expanding. And I think right now they're covered for you know say a year and a half. And he Saylor talked about, I think, wanting to increase the coverage to 2 years. So just even on their current liabilities, there's room to expand the reserve. And also as they issue more preferreds, the cumulative outstanding liabilities are going to increase. And so, if you're looking to maintain a certain runway, then obviously you're going to have to keep growing that cash reserve as the runway that you need grows larger. So I think it did make sense to just establish the initial reserve in one shot and not kind of DCA it out over a year. I think it made sense to just do it in one go and get it done with. But then
Hmm.
also there's still going to be a need to incrementally add to it over time. So yeah, I think the way they've done it makes sense to me. Um, I don't know that there would have been a whole lot of benefit to do it over a longer period of time. Um, I think just getting it done, one shotting it made a lot of sense.
Yeah, no, for sure. At least establishing that initial pot here. Well, okay. Let's not just pick on strategy here. Wanted to also talk about Strive. You had a recent tweet about them. They're another treasury company that's out there doing their own thing. But you talked about their capital structure, and you pointed out how right as of now, at least, theirs is a bit more simple. They have their common ATM that they just set up, and then they have their, I believe, one preferred stock. Whereas if we look at a strategy like we were just talking about, they have multiple preferreds. They've done convertible notes in the past. They have their ATM, so a bit more convoluted there. Can you talk about? Because you also worked at a treasury company. Can you talk about from a leader's perspective of a treasury company, how one might think about the pros and cons of having a more complex capital structure versus a more simple one? What are some of the advantages, disadvantages to think about there?
Sure. I think there's a couple different considerations. I think one, the what is really, I think, critical is to get to a point where you've got some form of automated sales, which is done through the ATM in the case of SATA and also the common equities. And because the alternative to that is basically having to go out and do a private placement every time you want to raise capital, and that is very difficult to do. And it's also the first thing that dries up when the market turns south. If instead of say instead of strategy selling $1 billion with its ATM to raise capital for its fund, if it had to go out to the market and pitch individual investors to raise $1 billion because they wanted to establish a cash reserve, I guarantee you they would have a much more difficult time doing that. But when you're just selling into the open market because you've got this ATM facility, that gives you a lot of flexibility to just execute your strategy without having to have every single step of it gate kept. And also, I think there's a real benefit to having just a simple cap structure with just a couple products, or maybe even just one product, like Strive currently has. Which is that when investors are looking at your company, um, if they can't really figure out what it is that you do, or the instruments are so complex that they can't really figure out what their exposure is, they can't really understand what the risks are. I think they tend to just shy away from those kinds of stocks. And also from an operational perspective, if your fundraising is kind of whatever crazy exotic deal that you can come up with that week, um, that also just adds like another source of instability to the company. Investors don't really know what's going on. And it's and when you go out and you try to do your next raise, and you just keep building on top of this crazy stack of exotic derivatives. It makes everything much more complicated. So that's why I think really simple capital structures with one or two products. Even strategies is starting to get a little bit complicated with all the different preferreds that it offers. But I think once their convertible bonds roll off and they just have probably a couple core preferred stocks they're leaning on, then I think the narrative becomes much simpler again. So yeah, that's my take on it. One, you really need a form of automated selling, and I think also you just need to have a couple instruments that really are your bread and butter, to keep the narrative simple, to keep the strategy simple, and for everyone to really understand what their exposure is with your stock.
Yeah, on the automated selling piece, maybe we could double click there. Is that from what you know standard in the industry? And are you just saying like, okay, this is just something folks should have, and it is what they have already set up, or do some treasury companies just not do automated selling? And if not, why is that the case?
There's really, I want to say, four companies that actually have live functional ATMs, and there's only two companies now that Strive has ATM and SATA that have an ATM on their derivatives that they're offering. Um, and so yeah, I would say that it's not standard, but that is really, I think, the bar to reach for having succeeded in the industry, for 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 you're separating yourself from being an also ran to actually being a serious player in the space. I think that is kind of like the minimum bar to achieve, is you need to have some form of automated selling put in place.
Hmm.
And I think that's a real question for some of the newer companies, is whether they can get that done. And I think it's been recognized for a long time, even with just a common ATM, that was going to be a significant hurdle for companies to reach, to get to the point where they had enough liquidity where that could even be feasible. And on top of that, if you say, okay, not only do we need enough liquidity in our common stock to do an ATM, but we need a preferred stock, or whatever it is we're going to take to the market, we need enough liquidity in that to put an ATM on it as well. That's a much higher bar to reach. But I think that ultimately is where the success line is. And I've had a fairly different view on some of the ways that companies have gone to market. Probably, say in the middle of the summer, I predicted that pipe would become the most unpopular word in the industry, and it did. But the flip side of that, I think, is that companies like Strive, if they had tried to bootstrap up just with private placements, just like raising $5-10 million a week, trying to build up from a handful of Bitcoin up to their current level, which is I think their pipe was like 500 million, something like that. If they had tried to piecemeal that out over a much longer time frame, I think it would have been very difficult to do. And it also just it wouldn't really made a whole lot of sense if they could just go to market and kind of one shot the capital base they need to get started. So I think these pipe deals, not all of them, but certainly the ones that have put companies in a position to take another product fundraising tool to market with an automated form of selling. Metaplanet, we saw them do a large international raise as well. It's just called a pipe. They are kind of now in position to do their preferreds. They don't have they haven't done moving strike warrants on those, or they don't have an ATM like structure set up yet, but I have to think it's coming. But I think these deals that initially were not so popular, the ones that led to a setup that is more conducive to long-term operations, I think those are the ones that we're going to see over the long run actually be quite successful once they get kind of past this period of uncertainty and shaking off all the after effects of the pipe unlocks and the price dynamics that bring and everything.
Gotcha. Okay. And as we look into maybe the next 3 to 6 months, so heading into 2026, of course, we'd be all very ecstatic, Bitcoin moons, treasury companies should follow in that case. But there are also other possible scenarios here. Potentially Bitcoin continues this chop sideways. Treasury companies have not done too well. in that environment, or could enter a bear market for Bitcoin itself. If we do, it's likely that treasury companies see the same fate. What do you think companies can be doing to prepare now? So we've seen strategy, create this cash reserve. Is there anything else you think other treasury companies could be doing now? And I guess also, as we're talking about it, why do you think other companies, maybe it's too soon, but haven't followed this move in terms of setting up a similar cash reserve system?
Well, there are really only three companies that have gotten to market with preferreds. So, unless you have a large, set of liabilities that you need to make good on during the bear market, you don't really need a cash reserve. If all you're sitting on is a bunch of zero coupon convertible bonds, you don't need a cash reserve. But in terms of what companies can be doing to prepare for a bear market, there's really only one capital tool that we've seen that actually really works in a bear market, and that's having some revenue. And if you look at strategy, not that granted we don't have a lot of data points. Basically, strategy is the only Bitcoin treasury company to have been through a bear market, but they didn't issue any convertible bonds for like 2 years. Either didn't take any loans. Preferred playbook, happened after that.
Hmm.
Basically, what they had was cash from operations, and also contrary to popular belief, the ATM didn't just start in November of last year. They've been running ATMs for almost the life of the program. They did ATM the common shares from time to time during that period. So I think what companies are going to need really is some form of revenue, and especially for the companies that they are essentially shells with underlying businesses that don't generate a lot of cash or just break even. They're going to need to do something else, and because there's going to be no private placement money if there's a bear market. But if you're a company that's sitting on a couple thousand Bitcoin or even a couple hundred Bitcoin, your company never is really going to be in that bad a shape unless Bitcoin just dies, which I don't think is what's going to happen. So there are other ways to do it. I think we're going to see where companies deploying their Bitcoin for yield. And as far as I see it, there's really only one way to do it, which is lend it to various derivatives trading strategies. Either do it yourself or lend it to someone else who's going to do it on your behalf. Because right now, like, you can't invest it in another business. The whole premise of the Bitcoin Treasury Company is that the highest and best use of any cash you have is not to develop another business line, is to put it into Bitcoin. If you had another more profitable business you were going to deploy it into, you just build that business instead of building a Bitcoin treasury. So you can't really deploy it to invest it. If you lend it, whoever you lend it to has to have a use case that returns more than Bitcoin. And really, the only people that plausibly have a case of doing that right now are companies that are traders that have some way to get Bitcoin and Bitcoin returns, whether that's a covered call program or you're doing kind of margin trading, puts against that. We've seen Metaplanet do cash secured put program, but it doesn't have to be cash secured. You could post the Bitcoin as collateral and sell puts against it. There's different ways of doing derivatives trading. There is some demand from market makers where they need Bitcoin for their own purposes, and they're able to reliably pay interest rate on the Bitcoin that they borrow. But I think for companies that really are sitting on a large pile of Bitcoin, and probably would struggle to raise capital during a bear market, the safest thing for them to do is to deploy that Bitcoin for yield. Probably with a very conservative covered call programs, probably what I think we will see more people do. But there are other ways to do it as well. And of course, it's not risk free. But same token, if you're a company that has a lot of Bitcoin and your whole premise is that the value of the company is raising more Bitcoin, then you better be doing something. And probably the best thing you can do in a downturn is a yield generation program, such as using derivatives.
Yeah, yield generation. If you have some cash flow, use that. Could also be a good case for setting up the cash reserve, right? As well, we talked about it in the context of paying back, um, dividends on these preferreds. But if you really think a bear market's coming, and you still have this MNAV premium, might not be a bad idea to raise some capital there, deployed in the bear market to buy more of the underlying asset. Do you think debt could potentially play a role? For at the bottom of the bear, do you think it's prudent for some of these companies to, maybe take out loans? Obviously, you'd want to make sure they're not callable, and there's good structure there. But do you think debt could potentially play a role in that scenario?
Good. I think you always have to be a little bit careful of thinking like, okay, this is the bottom, so I'm going to borrow to buy it on the premise that it's the bottom, and then thinking that cash is going to come in later to pay it off. I mean, if we're right about Bitcoin, it goes up over time, but I think you want to be careful as a company about buying Bitcoin as a long-term strategic asset, and then turning your treasury into a day trading operation. Like that I think that's a very careful line that you want to draw. But borrowing to buy Bitcoin during a bear market can make sense. And as long as you have cash flows to cover the debt service, because typically the types of credit facilities that are going to be available in that situation are going to be um, collateralized borrowing against your Bitcoin holdings, and the rates on that aren't cheap. There's probably going to be 8 to 10% interest rate you have to pay on it. And the rule of thumb is that the worse the Bitcoin market is, the worse the terms you're going to get on any kind of debt. So really, just one, you have to have that cash flow to be able to service the debt. If you're going to borrow to buy Bitcoin. Convertible bonds in a bear market are basically a non-starter. I've heard people say, yeah, if we're trading at 0.9x MNAV, we'll just do a convertible bond at 130% premium or whatever it is, and we'll just get that back over 1x and make that accretive. And I don't think that's going to happen, because the demand for that just isn't there when Bitcoin is in the dumps.
Hmm.
If you're going to borrow, most likely it's going to be a collateralized line of credit. And like I was saying, the way you have to have revenue to service the interest rate on that. So I think it's as simple as that, really.
Okay, makes sense. Yeah, I just want to make sure covering all the bases here. And you had another really interesting post regarding tokenized Bitcoin stocks. So tokenization has become a really big theme this year. Larry Fink's talking about it. You have Tom Lee talking about it as well. The tokenization of everything. When it comes to you know, tokenizing these Bitcoin treasury companies. On the one hand, you are, expanding access, to these assets in terms of giving exposure to them and potential investors across the world. But at the same time, the concern with tokenized stocks, at least, is that the investors or the holders of those tokenized assets don't actually have a claim on cash flows from the business or any of the assets. Curious what your thoughts on that, how you not necessarily kind of see this playing out, but um, how folks should sort of think about this as they sort of see these new products come to market. There clearly are some benefits, as I was describing, but some things to be careful about as well.
Yeah, I think, even for the Bitcoin treasury company, even if you just, own the stock in your brokerage account, you don't have a claim to the company's assets. You can't, withdraw the Bitcoin. So I think, wrapping a layer of tokenization around that doesn't change that in my view. I think that really, the hope for, people who do like the idea of tokenizing assets is that it just makes them easier to trade. Right now, if you want to trade, strategy stock or whichever Bitcoin treasury company is your favorite, you're limited to 9:30 a.m. to 4 p.m. Eastern time on the United States Stock Exchange. At least if you're trading in the United States. or whatever your local stock exchange hours are. But if we could move to a more tokenized system, then you could potentially have 24-hour trading. You could have faster settlements. Right now, T+1, or depending on where you are, potentially T+2. It takes time for trades to settle, which can be annoying. Probably if I would suspect several folks who've tried to aggressively trade in their IRA accounts have been hit with a trading restriction a time or two for free riding restrictions, where you buy, sell, and then buy again, and you're trading with unsettled funds. If you have faster settlement time, that eliminates that problem, because if it settles instantly, you can't ever have a free riding violation, because every trade is always instantly settled. So I think that tokenization of stocks, I think, really is, from a quality of life perspective, could make things better in terms of just trading hours, access to stock. I think probably one thing that is not fully realized, though, it doesn't solve every problem. These stocks are still going to be securities, and because I think that kind of the dream is that, like, I could just buy a European stock, I could buy a Japanese stock, I can buy South American stock, I can do it all very easily in this one online platform with this tokenized stocks. But it might not work out being that easy, because all these are still going to fall underneath their own jurisdictional regulations. And so one of the things I learned doing business internationally is that it's actually fairly tricky for a European company to issue a stock to, say, American investor. There are extra steps you have to go through to make that happen, and tokenizing the stock doesn't make that go away. So I think that, but still, it's something I like to see. I think that especially if we get a Bitcoin, more of a Bitcoin-based economy in the future, that all these different use cases will be pulled on top of it. Because I think the benefit of trading tokenized stock, it's somewhat marginal, to be honest. It is you can point to tangible quality of life improvements, but it's marginal enough that it doesn't make sense to build like an entire blockchain just to do that. And so that's where I'm kind of bearish on other chains, which I won't name, that say, like, yeah, our goal is to be NASDAQ on the blockchain. I don't think that's enough of a use case in and of itself. But if you have Bitcoin, where the network has its own purpose unto itself, and you can add tokenized trading on top of that, that's when these other use cases, I think, start to make more sense.
Gotcha. And so you don't think this will compete too much with the idea of having a Bitcoin or the necessity to have a Bitcoin treasury company, as some people, view as something that'll be needed in each international market, because of some of the barriers that still exist for, these tokenized stocks to be accessible across borders.
Yeah, it's because it's not an access issue. It's a mandate issue. If you're in someplace in Europe and you have a mandate to only invest in European stocks, tokenization doesn't change anything for you, because you still have this mandate that says I can only invest in European stocks. Or if you're a fixed income manager running a portfolio, a fixed income portfolio, and your mandate is I have to invest in my universe of potential investments is bonds and preferred stocks. Well, that's still all you can buy. Tokenizing a Bitcoin treasury company on the other side of the world doesn't change that for you. So I think the what changes the investment case for Bitcoin treasury companies is if sorry, still a little bit sick from the flu the past week here. But yeah, what changes the investment case for Bitcoin treasury companies is if suddenly every fund in the world got the ability to buy Bitcoin. They could buy Bitcoin, they could buy ETFs. every fixed income manager suddenly they can buy Bitcoin. I don't know why this would ever happen, because if you're a fixed income fund, why would your mandate ever allow for Bitcoin? But just hypothetically, if it did,
Mhm.
then you might be less interested in buying, Strive for Strive or Stride or any of these, um, because you could just buy Bitcoin, you find Bitcoin returns. But I don't think it's going to happen, because for one, these mandates exist. One, because investors want particular kinds of exposures. Also, if you're a pension fund, um, that where your base, your constituent base is whatever local geography you happen to be in, and you operate at the pleasure of whatever government you happen to be sitting under. They're going to want to insist that some of those funds be invested locally. So I think these pockets of different funds that have limited pools of capital that they are able to invest in, I don't think that really changes, or doesn't change very quickly. So the pools of capital to whom a local Bitcoin treasury company are interested in, I think that is something that persists for quite a while yet.
Mhm. Yeah, you talked about the potential, or not potential, but the restrictions for institutions. But how about for retail? Does that, you know, ability to tokenize Bitcoin, treasury stocks, does this not move, could retail not move the needle there? Um,
Well, I think it depends how they're buying it. Let's say if let's say we were to tokenize the stocks in the United States, and can I hold it in an IRA somehow? Or if I'm in Sweden, can I hold that in an ISK account? If I'm in UK, can I hold that in my SIP, or I forget what the other kind of account they have is called? But um, the it's I think it's not a mechanical access issue. It's what can I say? It's a legal issue. It's not a technical issue, in terms of what I can access, within the different tax wrappers I have available to me that make it tax advantage to trade. So I think that within just your taxable investments, if all you do is taxable investments, I think those that is probably where tokenizing stock is going to have the most impact, just
mhm.
because that's where people are kind of just trading more freely whatever they want to trade, and that's where just the mechanical access issues are more salient. For example, let's say you want to buy a stock listed on an exchange in another country, and none of your brokers offer access to that. That's a mechanical restriction. That's it's not necessarily a legal restriction. It's just for whatever reason it's too complicated for or undesirable for that broker to offer access to stocks on that exchange. I think that's where having a tokenized offering potentially becomes more desirable towards an investor.
Okay. Interesting. So yeah, tokenization, interesting thing to continue to look out for. Want to move over to the MSCI index. There's been a lot of chatter about that. Speaking of restrictions, currently, I believe strategies in the index MSCI committee is right now having discussions, doing consultation to determine whether they should keep strategy in that index. This could have big implications for strategy and potentially other treasury companies that would otherwise be able to be included in the index, because there are a lot of funds that track these indices and buy the stock because they're included, right? And so strategy's argument is, hey, MSCI, you shouldn't be able to pick the winners, pick the losers, and sort of make these determinations. I'm curious how you're kind of viewing this and thinking about whether the index should be able to just change the rules now, and what some of the implications might be for potential inclusion in other indices. Right, strategy is a potential candidate for the S&P this year. They just got included in the Nasdaq 100 last year. Could this have some sort of cascading effect down the line potentially? Do you see that happening?
Yeah, I mean, index exclusion, I think, would be very, in the short term, it would be a black eye. It would be, you know, it would result in, a sell off. It, might not last that long. It might last a couple days, just push it down. But, it would result in some red price action if index exclusions were to take place. Um, that said, it remains to be seen whether or not that actually happens. We've seen, last week Strategy put out a statement, and then just today they put out another statement, and then also they had some convenient links in there. So if you want to go in and you want to protest um, Bitcoin Treasury company exclusion from indices, go to Strategy's link. You can register to support Strategy. You can send an email to MSCI. Recommend doing those things. But personally, I think that should the indices be prevented from doing this? I mean, no, it's a free market. Indexes can do whatever they want, but should they do it? No, I don't think they should. Because why would you? I have to think that the only reason they're even considering doing it in the first place is because their banker buddies aren't happy about um, these companies getting as much attention as they're getting. If your strategy and you've beat out the your 5 year returns like dwarf everything in the S&P 500, and you're outperforming so many companies just by buying Bitcoin. Um, and if you're a bank that probably still sees Bitcoin as somewhat of a threat, then maybe you start leaning on other people in the space to try to disincentivize some of the economic activity around these companies. Yeah, I don't want to dig too much into speculation about who's doing what, but
Hmm.
um, I don't see this move is being an organic. Yeah, we genuinely don't think companies that have Bitcoin belong in the index. We genuinely think these are investment companies masquerading as operating companies. Like I don't buy that line of thinking at all. Um, it just seems more motivated by whatever leanings people at the indices have, or people who have influence over the indices have. Um, that's what it looks like to me. But yeah, it's still very much up in the air. I think the decision is January 15th. And right now it's an open comment period. So
Hmm.
Strategy has submitted their comments. I'm sure that other companies will. Strive's also submitted comments, and so we'll see where it goes. Personally, I'm not going to worry about it too much until and unless it actually happens. But I don't think it would be the right thing for the indices. I don't think that uh, investors. Why would you want to exclude exposure to some of the top performing companies that there have ever been? It makes no sense.
Yeah, and it's a slippery slope too, because it's like once you decide to exclude them, it's like you can't just turn around and change your mind. It would just look really bad for the index, right? For them to change their mind even a year down the line. For them, they might be better off just kicking the can down the road here, just really making sure that they want to set that precedent for the longer term.
Yeah, I think if you're indexed, I think really what you want is to be really just agnostic to the companies that are in the index. Just if the goal of your company, the goal of your index is to provide a wide benchmark for the different types of economic activity happening out there, whether it's a broad market index or a particular industry index, then you don't really want to be picking winners and losers for the index. I think probably something as close to a rules-based approach as possible is really what both the market would want and the operator of an index should want to fulfill on in order to fulfill market demand.
Yeah. Yeah, definitely. Okay. Just to maybe close here. So early in the conversation, I think you brought up Vanguard and some of their the moves they're making in the space. We've also seen J.P. Morgan with their levered Bitcoin notes. Bank of America is going to allow their advisors to start recommending Bitcoin to their clients in the new year. Why do you see these? Why do you think these moves are just happening now? Right, so DJT, the new administration came in about a year ago. Why do you think we're just seeing some of this now, especially from um, these traditional companies, a lot of which have in the past have come out and talked very negatively about Bitcoin. And in Vanguard's case, even banned their clients from purchasing through them.
Yeah, I think it takes time. Um, I think it's the whole industry doesn't turn on a dime just because of an election. I think it just takes time, especially at larger institutions, because there's probably such as one person making a decision. It's uh, if you're going to offer access to an ETF, there's probably there's several different teams involved. Just several. I can't even imagine how much red tape these companies have to go through internally. Just even having been at a smaller public company that I think we happen to be quite agile, but still there were processes to go through that take time. And if you're an even larger behemoth, that there's just a lot of institutional
Mhm.
process to to get it done. And also, I think that the ETFs kind of need to prove themselves out too, because if you're say you're Vanguard and you're looking at the ETF launches and you're very skeptical and you're saying, what, we don't really need Bitcoin. Before the ETF launch, that is a position that you can just kind of ignore the ETF. You might be able to think you can ignore the ETFs, but a year post launch, when it's one of the most successful, if not most successful ETFs that has ever been put on the market, and you yourself are primarily an ETF company, and your competitor has the most successful product ever, and you don't have it. Well, that's when you start to change your mind when these things
Yeah.
happen. You can't ignore it anymore when it gets that big. Um, and especially your internal stakeholders who probably at the outset, they can be convinced by your line of reasoning. They could think, okay, yeah, well, we've heard your words and we're on board with you for now. But a year later, when they say, the billions of dollars in missed revenue, and they start to change their mind about these things, money talks in a big way.
Right.
Um, and it's probably the same situation with the new forms of levered Bitcoin exposure coming to market. Um, if you see Bitcoin treasury companies succeeding, you see all different kinds of levered ETFs put in the market, you start to think, well, you know what? Why shouldn't we take a piece of the pie too? And when you're a larger institution, you can just kind of sit back and wait for the market to show you what it
Mhm.
wants. You got more flexibility to do that. You don't have to be on the bleeding edge of something. So yeah, I think basically just institutional process and also companies just having had time to see how the market played out. I think it explains most of the lag between uh, having a pro Bitcoin presidency come and then the actual effects of that happening somewhat later.
Yeah, no, fair enough. It's still kind of crazy that Vanguard would allow BlackRock to have a 2 year head start, and kudos to BlackRock, they were on it even before the new administration. They had released their ETF. With J.P. Morgan in particular, with their levered notes that I believe are supposed to deliver about or they aim to deliver a 1.5x return on Bitcoin, with some additional risk there. How do you see this competing with treasury companies like MSTR? It's case that MSTR can maybe give you a 1.5x, but it could also give you a 2x, 3x. We've seen with some other treasury companies potentially get more than that, but you also have the downside case where when we're in a bear market or we're dropping they don't perform as well. Do you think this like 1.5x that does give you an additional benefit, but isn't too volatile or as volatile as some of these treasury companies will, be a very competitive product to the treasury companies, or do you think these are completely distinct, items in the market?
Yeah, my sense is that probably it will complement market offerings more than it is a competitor. Because Bitcoin Treasury Company is still a very different kind of exposure. It's not pure leverage, and the premise is, we're you're not just getting say 1.5x leverage on Bitcoin. Your actual Bitcoin exposure is increasing over time, permanently. As long as the company doesn't sell, you're getting a permanent increase in Bitcoin exposure over time. If the company issues a convertible bond, that convertible bond converts, and that increase in Bitcoin exposure is crystallized. If you're doing a preferred stock, you're issuing more of that over time. You're continuing to increase the Bitcoin in the balance sheet. If Bitcoin is going up and you're capturing this spread between interest rates and Bitcoin appreciation, then there's an ongoing benefit to that. So I think it's a very different kind of exposure, and I think that really at this stage of the game, everything that comes to market taps into a slightly different customer base, is a net benefit in increasing the size of the market for everyone. So I think that right now it's all about increasing the size of the market. I don't think
Mhm.
we're really at a stage where it's not like cell phones where there's almost 100% penetration and the only way to get market share is to take it from someone else.
Mhm.
We're still very much in a grow the market um, phase for Bitcoin, and so I think these different products that are slightly different exposures have slightly different target buyers for them. I think just the more of them that come to the market, the better. The more we can normalize investing in different kinds of Bitcoin derivatives, the more we can get those funds funneled into Bitcoin and grow the ecosystem. I think it really is beneficial to everyone in the ecosystem.
Yeah, no, great points. Makes sense. And maybe to wrap here, so Bank of America with their advisors now being able to recommend Bitcoin as we look into 2026 and the outlook there. How do you think this will sort of impact or influence, and how long do you think it'll actually take before we start seeing some of the impact of these new flows into the market on Bitcoin's price?
My guess is it will probably take some time, like being able to recommend and then actually doing it, or there are two different things. So I think that what really becomes interesting is not just like they can recommend it, but when advisors get to a point where they have like a standard portfolio recommendation of 3 to 5%, and this is a company-wide policy. I think this is when things start to get really interesting. Definitely like being able to recommend it is a positive step. I just think that my short-term expectations would be a little bit more muted, and I would be more excited when it gets to the point where it's actually a standard allocation recommendation.
Okay. Awesome, Brian. Well, thank you. That was, I think, really good. We covered quite a bit there. What are you looking forward to for the rest of the week, and what's your view on what we're going to see here with FOMC today?
Yeah, for the FOMC, probably the way I put it, a hawkish rate cut. Probably they cut, but then try to signal that not to expect too much more in the near future.
Yeah.
That would be my guess. Um, yeah, the whole Fed situation, it just feels like we're in a holding pattern until we get a new Fed chair. Um, Powell he doesn't seem like he wants to rock the boat. He just trying to resist the Trump pressure to slash rates to oblivion. But you know, I just don't see too much excitement until we get a new Fed chair, which will happen next year. So um, yeah, aside from that, what is coming up here? I think that's 2026. I think will not be the typical end of year drawdown that we've seen in years past. I think the stars are lining up for something very different. Whether that's the Bitcoin bull run that everyone hoped for in 2025 finally materialized in 2026. I'm not sure if it'll be as much as all that, but if it's positive at all, I am actually hopeful that we will see some pretty significantly changing attitudes towards Bitcoin.
Hmm.
If we just don't see an 80% drawdown, if even if it's only like the worst it gets is a 40% drawdown, or there's no drawdown, I think there will be a lot of different attitudes towards Bitcoin. I think it'll make people more comfortable holding it over the long run. It'll make people kind of less scared of the volatility. And I think one of the things I've been thinking about that is kind of like a dark horse attitude changer is the attitude towards Bitcoin as a medium of exchange. And I've just been thinking about, especially with Square going to market and rolling out Bitcoin payments to their terminals, nationwide. I think more people that within the Bitcoin community I think there's a lot of people who think, I would like to be on a Bitcoin standard. I would just like to have my wallet loaded with Bitcoin. I'd like to spend Bitcoin. I think there's a lot of people who are kind of inclined to that, ideologically, but just don't because the volatility is such that it hasn't been practical. The tax reporting it's like DDoSing your tax filings with a million taxable statements. But with platforms like Cash App, with platforms like Strike, where they can just issue a 1099 for your Bitcoin usage, that kind of wipes away some of the logistical hurdles. And also if Bitcoin volatility is reduced just that little much, I kind of feel it myself. Like I will be more inclined to just keep
Hmm.
some Bitcoin on a wallet, take it around with me, and use it, at the coffee shop or wherever it takes it, just because I want to, support the growth of the ecosystem. So I think that's I've become much more bullish on Bitcoin as a medium of exchange happening sooner rather than later. I've become much more bullish on um, end of potential disruption of Fourier cycle pattern, leading to not only more investment in Bitcoin to store value, but medium of exchange, and really just all up and down the ecosystem. So that's what I'm excited about right now.
Awesome. Well, we're gonna be in 2026 soon, and yeah, hopefully, a lot of this will come to fruition. I think, like you said, even not having that big drawdown would be a pretty big win for Bitcoin. So we'll see what happens. But yeah, we'll be counting down FOMC today, and then interesting year ahead. So thanks for doing this again, Brian. Appreciate it.
Yeah, always good to come on the show and talk with you, Charles.